Right. Hi, everyone, and welcome to the panel for today. We are looking at whether we are in a startup bubble. We have a great panel here with us covering both the VC and the angel perspective and understanding both the valuation and also the looking forward at the future of investing into startups. My name is Olivia Sibony. I am co-founder of a platform called Seed Tribe, where we matchmake impactful entrepreneurs with angel investors. I'm also an advisor at the Department for International Trade, where I help impactful entrepreneurs from around the world to relocate to the UK. So with us today, we have an impressive panel. I'm going to ask each one of them to introduce themselves. So if you could please say who you are, who you represent, and any particular areas of focus in your investment. I'm going to start with Sam.
Thanks, Olivia. Lovely to be here. My name's Sam Louis. I represent, we have two organisations, I suppose, that we represent. At the very earliest stage, I represent Angel Investment Network. We are the world's largest network of angels and early stage investors. And generally, we look to help entrepreneurs get access to great investors all around the globe. We have about 250,000 investors registered worldwide across about 90 countries. And essentially, we create a global marketplace for investors and entrepreneurs to connect. We are largely focused at the sort of seed through to about Series A stage, but we have very little in the way of focus. We really try to make it a pure marketplace. And then we also have a venture capital arm where we focus on the Series B through to pre-IPO stage, and that's called AIV Capital. With AIV, we again are fairly sector agnostic. We work on a deal-by-deal basis, and we're largely focused on European startups and companies in the US. We're based in the UK, but we operate all around the world. And it's an absolute pleasure to be here.
Thank you very much, Sam. David, over to you.
Well, good evening, everybody. It's an absolute pleasure to meet you virtually, at least this evening. I am David Dalton, co-founder of Oyster Venture Partners, based here in London, but also in Manchester and in Belgium, and soon to be in Cambridge. We are an intermediary operating, I think, slightly further down the chain from where Sam started, the angel, and we very much engage with companies around the Series A level. We are specifically focused on life sciences and on digital health and nothing outside this particular sector. We work very closely with trade agencies around the world, but in particular 5 of them in Europe. And our business model is to effectively take newly innovating investors innovators, I beg your pardon, through to investment at the Series A stage, when it really begins to get quite tough from their point of view. We have 8 in our team. Our clients are based in the UK, of course, also in Europe, but we have some outside Europe, 1 in South Korea and 1 in South America, for which we are raising capital on the West Coast. And many of our deal flow comes from all of those regions. So it's a great pleasure to be with you this evening, and I look forward to speaking to you again shortly.
Thank you very much, David. Saket, over to you.
Thanks, Olivia. Good evening, everyone. It's nice to meet you virtually as well. I'm Saket Narula. I'm the investment director at Fortunatus Capital, which is a single-family office. We are based in central London, and with the aim of investing in pre-seed, seed, and early stage Series A, venture capital, entrepreneurs, and innovative companies, primarily in the UK. We are quite sector agnostic. We are tech generalists. So anything with a social impact, environmental impact, and strong purpose in these 2 fields, we get excited about. We are a home office endorsing body, so we can bring entrepreneurs from around the world and help them relocate, as well as pre-seed invest in them to establish themselves in the UK. I look forward to the conversation.
Great, thank you. Hussein.
I'm Hussein Kanji. I am a partner at an early stage venture capital firm that invests across the pre-seed and seed stages called Hoxton Ventures. We've been around for about 8 years. We tend to invest in about 25 companies per fund. We're managing our third fund, which is about $200 million. And prior to this, I was an entrepreneur myself, building tech companies predominantly in the Bay Area.
Thank you. Great. Apologies, I have a barking dog in the background. So I'm actually going to start with my very first question, which is quite simply the title of today's event around whether you feel that the tech market is overvalued. And more importantly, do you feel that we are about to enter a bubble with regards to valuation? I'm actually going to start this question with Hussein, and then I'm going to ask any other panelists to pitch in from there.
So I'm going to start by saying I've been saying that there's been a tech bubble since about 2012, and I've been forced to eat my own hat on Twitter. I used to call some of the ridiculous things I used to see bubblicious, and people would call me out on this. And it's been almost 9 years since I started this. Like most bears in the market, I've been pretty wrong. I think the timing for these things is really hard to call, and I think there is a huge supply of capital that wants to invest into technology companies. There is a whole amount of growth in the tech companies that's at kind of all-time highs. The markets are just bigger and deeper than ever. Are things overvalued? Arguably, yes. Are things overvalued relative to kind of historic norms? Arguably, yes. Does that mean we're going to probably stay overvalued for a while? My guess is, given the capital, probably yes. And it's kind of hard to say something's overvalued when people are willing to pay kind of insane prices into the future. Maybe it's actually pretty fairly valued. And so I've kind of come around kind of 180 degrees on that basis. But we're definitely seeing excesses in the market that are increasing over time.
Go ahead, David.
Oh, thank you very much. Yeah, certainly from our perspective at Oyster, we would certainly see that the market is clearly growing at an extraordinary rate. I mean, looking at the Q2 numbers, global healthcare investment rose for the 7th consecutive quarter, 34.7 billion across 1,600 deals. The European investment component of that was 6.9 billion. That was the 5th quarter of quarter-on-quarter European investment growth. Certainly, from our point of view, we see quite a high volume of deal flow, because we clearly work very closely with the trade agencies, including Olivia's organisation, the UK Department for International Trade, but others as well. And what we see is not just a growth in investment, but we see a substantial growth in the startups that are coming to market that are not invested. And that is really the sweet spot for Oyster Venture Partners. The Corporate Finance Institute in the US did a survey amongst a number of VCs that were in their midst, and they measured the investability or the investment rate for investors coming to innovators coming to the market. They looked at 3,000 innovations and 3,000 propositions that were sent to investors. And of those, only 200 of the 3,000 were looked at seriously. And of the 200 that were looked at seriously, only 20 were invested. So 20 out of 3,000 is 0.7%. So I know in the room are investors, but I know also online it's a mix of investors and of startups. So the space that we operate within in the marketplace is to very much improve the chances of investment for investors. For innovators, because the chances at present on average are about 1 in 142. And there are a whole range of ways that we do that to improve the investment rates. But I'd also say, from an investment perspective, investors are having to sift and sort extraordinary levels of deal flow in order to narrow it down to the 200 they look at seriously, in order to narrow that down to the 20. So we have done a lot of work over the last 12 months in working with VCs literally around the world to understand their internal processes and what it is that can be done to ease and make more cost effective their ability to process deal flow faster. And we are gearing our business and our model and the platform that we have been invested in by Innovate UK for that very purpose.
Yeah, I think picking up a little bit on both of those points, especially Hussein, to go to your comment about your sort of bearish feelings. I think that there's an awful lot of factors in the market that are driving valuations, as you say, huge amounts of not just capital, but also, David, as you say, there's a huge number of companies being started, which on both sides of the fence is massively increasing the competition. The evolution of technology is hugely increased. Again, David, as you say, the level at which companies are coming to the market. 10 years ago, most companies are still raising their first funding at around the 1 year mark. And the caliber of a company that you can build in a year these days, given the technological resources available, the off-the-shelf software, is vastly improved on what you could do 10 years ago. And so you have more companies contesting in more markets. That 0.7% is, an increasingly high caliber group. And you combine that with huge amounts of investment competing for those companies. Yes, things are inflated for sure, but whether it's, quote unquote, a bubble in the sense that it could pop and all go away tomorrow, that money's not going to go away. Those companies aren't going to stop being as productive as they are. Productivity probably isn't going to rise in line with the expectations that we think. Productivity has roughly stayed the same historically over like the last 20 years or so. But ultimately, you're just, we're kind of in a bit of a perfect storm for venture capital at the moment. It's an extremely sensitive sector to movements in monetary policy. And at the moment, all of the monetary policy is kind of guiding, the returns profiles essentially everywhere else down, while venture capital remains strong. And we've also had a national pandemic that's massively concentrated focus on a particular number of sectors. So, valuations in restaurant businesses are not vastly overvalued. We're seeing businesses either struggle to raise capital or raising very cheaply at maybe 1x revenues, 1.5x revenues. It's that there's certain sectors where we are seeing this overvaluation, but it's predicated on things far beyond just hype and kind of market sentiment. So yes, I think there probably will be a sort of deflation at some point in the future, but I don't think it's going to be a pop in the same way as a kind of traditional bubble.
I would just add one comment to that, Sam. I think you're right. I mean, we would see it at the moment as not as a bubble, but as an acceleration in growth, which may return to the original levels of growth that we have seen beforehand. And certainly the COVID effect has had an effect. We found it far more effective to operate on this virtual basis than we used to, getting on 45 flights a year. But of course, the original drivers are still there. So aging populations and so on are still driving investment in innovation at an extraordinary rate, because municipalities cannot keep up with the increasing healthcare burdens that there are in the developed countries.
Thank you. This is perfect cue to Saket, because I believe he's got an overview both in terms of the healthcare perspective, but I'm also interested in your view, Saket, in how you've sort of straddled the sort of more traditional investment world and now moved into the impact world, and you also have a view on or a background in public policy. And I'm interested to hear your perspective on whether you, as with this hat of investor, you've seen a change in focus on how you look at your investment strategy or valuing investments. Is there a different strategy that you anticipate for the future with the new worlds that we now operate in?
Thanks, Olivia. That's a big question. So I'll try and make a clear answer. Having lived through the global financial crisis in 2008, again, that was the sign of rebalancing in the world. And then the markets opened up. I was a leveraged finance banker at that point, and there was a lot of leveraged loans being issued. in 2009, 10, and 2012 when Hussein said, the world was going back into a bubble territory. So there was a very quick recovery in the public markets, in the leveraged loan markets. So really large real money capital in the world. On balance, in the past 10 years, what I've also observed in the private markets, particularly in venture capital, is there's always going to be a divide between the United States and, let's say, Europe and UK in terms of how much capital is available for early stage and late stage investments. So I don't think there's enough supply as an argument for all of the UK and European ecosystem on balance with the more mature US market for private venture capital. That being said, now I'm in a new position, given my background was not in impact investments. But I'm also, someone who believes that the government of most countries is supposed to be the biggest and most established impact investor. And to define that more so in the early stage is very hard for us. So what we are trying to do is work with people in establishing what impact really means and how early stage investors and early stage entrepreneurs can address some of the societal and environmental challenges. There's been a very good shift, I think, both politically, socially, in the investment spectrum, that the debate to try and address these issues has become real. And there's money being deployed towards it. And people are looking at measuring impact, because if you can't measure it, it doesn't matter. So they are trying to measure it more so, and as are we. So in the early stage, a lot of the impact measures go hand in hand with some of the commercial measures of value creation of the businesses. But we are very keen to, as impact investors, really find entrepreneurs and innovators who are trying to find curative solutions to problems rather than just palliative solutions. At that stage, we are happy to be ecosystem builders. And I think the British government is very supportive of providing capital to just innovation and entrepreneurs. But the private markets and private investors like us, we are still keen on returns in an environment where rates are low, other asset classes aren't really yielding enough for returns, like Sam was saying, high yield returns really low in single digit percentages, while the required returns for venture capital still remains high. For us as a family office, we probably are on the lower side of the expected return on our investments compared to some of the more traditional 10-year LPGP funds, and most definitely compared to crypto as an asset class. So I will segue into valuation. So impact valuation for us is yes on double underlying strategy of providing value and creating commercial value, but at the same time encouraging entrepreneurs who are really trying to solve a social problem. Even if we don't see them getting enough scale to actually have a large enough business which will go into Series B, C, and D, and eventually list in the public markets. But I think there is a space for it, and over time we expect more late stage funds to carry on investing in the impact entrepreneurs.
Thank you. And do you see do you anticipate any shift in public policy that would impact the way that VCs or investors would look at their investment strategy or their valuation and due diligence?
What I'm seeing, and what I'm really pleased to see, and hopefully there are some investors out there listening to us, and I've had the pleasure of having worked with a few stalwarts in the industry who've worked very hard in the UK and in Europe for almost 3 decades to try and bring more real money into venture capital. And I'm particularly talking about pension funds. So there has been encouraging, reports that pension funds are now looking at allocating to the VC space within the alternative investment market. I think private equity has had more success because of investing in more mature businesses, EBITDA positive, at least cash flow generative. But we are seeing, a change in policy towards allocating towards venture capital. So these large investors are definitely the ones that move the needle. Small investors, family offices are not enough to really make a systemic change and shift in the space. So I think policy from both these pension providers and pension funds, consolidation of a lot of these fragmented asset managers that control pensions and investment funds like ISAs, which are special purpose investment tools the UK government makes, so that they can be realigned to not just invest in public markets, but also, in venture capital, are all all right measures that the government and the policymakers are taking. Yet there's much more that can be done.
Thank you. Hussein, I'm curious to know if the makeup of or requirements from your investors has changed at all in the time that you've been running the fund.
No, not really. I think it's been a bull market for the technology companies, both in the public markets as well as the private markets. What we've seen is a lot more U.S. institutions, predominantly endowments and foundations, that allocate very large amounts of capital to private equity and to venture capital, becoming interested in Europe. When we first started our fund, 8+ years ago, we were largely selling a product that nobody wanted to buy. This idea that you could invest into really interesting European companies that could grow up, to become, category leaders and go public, was something that, the American venture community did really well, and people understood that, but they didn't think there was any substance to that in Europe, and it was very difficult to convince them. So we used to joke, the Americans kind of got venture, but didn't really believe in Europe, and the Europeans didn't really get venture or Europe, and so weren't willing to invest in these kinds of things. That's changed 180 degrees on both sides. So there's a ton of European institutions, the private wealth folks like Lombard or LGT, that are interested in venture as an asset class, and there are a whole bunch of American institutions that are now allocating capital. And that's been the biggest dramatic difference between the two. In terms of what they're looking for, it's exactly the same thing as what we set out to do, and what everyone does in venture, which is generate the highest returns possible. I think the bar's gone up. People used to expect venture firms to deliver kind of net 3x was good, gross 3x was mediocre. I think these days people expect more than that, but all you have to do is look at Apple's performance in the public markets as kind of a benchmark, and if Apple can do that well as a public market, large cap type stock, you as an investor into much riskier companies that are much younger stage should be outperforming at least that bar. And so the bar has gone up, but the expectations are largely the same, which is go find really interesting companies, be their first check in, their partner, walk them all the way through until the IPO process.
So your risk profile hasn't necessarily changed. I'm particularly interested in knowing whether in understanding risks could be, for example, policy change, a virus, another flood, a fire, etc. Does that enter into your pricing strategy when you're looking at the investments that you make?
So I think when you're in one of these market environments where there's a lot more capital chasing after opportunities, kind of basic microeconomics takes over, and supply demand curves being what they are, prices generally tend to go up when there's a lot of demand for a scarce supply of companies. And there are a lot more companies today, but the amount of companies that become really truly distinctive $1 billion or $10 billion plus companies is still pretty finite. There's a lot more people looking for this stuff, and we've seen prices in Europe go up 3 or 4-fold over the last 8 years. So prices have gotten more expensive. We've also seen and the investment cycles just become a lot shorter. So both on the fund side as well as on the deal side, we used to deploy a fund every 3 to 4 years. Our last fund was 2.5 years. We fully expect this current fund to kind of probably be closer to 2 years. It just shortened. And then, I came off a call before this where the entrepreneur told me, point blank, I had my first meeting with him. I got introduced to him on Friday. So I had my first meeting on Monday. He's running a process. He's going to wrap this entire thing up in 2 weeks, done and dusted. So the cycle for investing has gotten a lot shorter if you're interested in, if the rest of the market does it this way, even if you might want to take an extra week or 2 or a month, you can't really do very much, right? Because the pace is being set by the market overall. So the pace is higher, which I would argue probably means we're more risk taking these days as a community than we were a few years ago, just because there's no way you can get everything done, over the course of 2 weeks if you're going to write a check. But that is kind of the market. So we're spending money faster, we're spending money probably looser, but I don't think anything is going to change anytime soon, because that's just the cadence of the market right now.
Thanks. I'd love other perspectives. And David, for example, or Sam, as you've unmuted yourself.
Could completely agree. And I think to add to that, when people are raising these larger funds, the larger the fund you have, if you're still investing in the same space, if you're not massively increasing that check size, then it's harder to deploy more tickets in a finite amount of time. So increasingly people are happy to invest larger tickets at slightly higher valuations, because obviously the dilution can't move too much. And that just means that, not only are people moving faster and looser, but they're doing it in a bigger way, because you still have that same cadence of turnover between funds, but your fund is just that much bigger. I think 4 or 5 years ago, the average fund was about 149 million. In the UK, it's now well over double that, which, often you have a similar sized team. You're still looking to invest a similar sized number of checks, because you only have so many days in the year. And as everyone's pointed out, there's only really, when it comes down to it, when you're really looking at that top echelon of companies, there's never more. Technology is meaning that we're seeing those outsized returns in more and more sectors, which is sort of expanding the opportunities, but you also have increasing numbers of specialist funds who are going to compete with you in each of those specialist sectors. It's a strange sort of headspace that you have to operate, I suppose, if you want to go into venture, and you want to, whether you do that as an LP through a traditional GP fund, or whether you do it as an angel. You need to kind of hold this dichotomy of thoughts in your head, whereby you fully understand that what you're getting is potentially overpriced for what it is in comparison to the vast majority of the rest of its competitors. A Facebook compared to most other social networks in the world, there's still local networks, we still have local forums. My local neighborhood still has an online forum that operates in much the same way as Facebook does. You can post stuff, you can talk to people, but ultimately you have one that's really going to win. And that just means that you're overpaying for this, but if you pick the one that wins, then the fact that you overpaid doesn't matter at all, because your potential for returns are just astronomical. If any of the investors here are thinking about this as a space to move into, if the rampant quantitative easing has likewise pushed your attention towards this space, don't be afraid, I suppose, by this notion that it does all seem slightly crazy, I suppose, at times. It's you're not alone in that. You're not kind of the odd one out and everyone else is sort of thinking that this is perfectly normal. It is a product of our situation and of our current moment in history. And I think, as Hussein articulately put earlier, it will change at some point in the future. And there is almost the bearish sentiment in the market. The fact that we're having a conversation like this, where we have 5 people who are all sort of cognizant of the fact that things are unusual, is actually one of the things that points to the fact that it's maybe not a traditional bubble, because we don't have sort of broad bullish sentiment. There's various factors that sort of pull us back from that edge where things could just go pop. But just make sure that you take your time to understand the space and to get comfortable with this notion that valuations are excessive, and for some things that's going to mean that you overpay for a company that doesn't go well. But it also means that you're creating the opportunity, especially with this increase in later stage funding in Europe, which is fantastic, whether it be from the growth of European sentiment or increasing interest from American sentiment, it means that we do have increasingly more opportunities for companies from all over the world to actually go on and become, kind of global market leaders and produce significant returns for any of their investors throughout the journey.
Well, I think there were some very interesting points raised there, including the ones about risk. So certainly in terms of the deal flows that we see, clearly these are organizations coming up to Series A level of investment, and because as the volume increases, the granularity of the solutions tends to get finer and finer. And one of the issues that we came across in our recent survey, literally a global survey in the development of the phase 2 of our platform, was that in speaking to investors about their internal processes, aside from the volume issue of sifting and sorting, the other thing that became obvious was that not every investor has the capacity to go deep without taking external advice on all of the propositions that it is considering. So you then end up in a situation where there are deals to be done, and if there isn't the backup and the support for the due diligence on a particular type of proposition, then of course the risk factor is an unknown quantity. So one of the ways we're looking to address that is to build obviously a supportive strategic advisory board, which of course many people have. But the degree to which that has been taken up by the investment community with whom we are working is quite significant, and has been to tell us that in fact, pre-due diligencing on a credible basis before propositions are provided will help enormously. Literally in August, we had 6 molecular diagnostic propositions to test for pan-cancer indications. 3 of them were based on circulating tumor cells, 3 of them were based on exosomes. So the first thing is basically which way is the market going, which way do we go? And then once you make a decision on which way you're going to go, then you've got to basically fine tune the proposition. And that of course comes down to other factors to do with team caliber and capability, the traction they have in the market, and so on. So the coordination of the pipeline, of the flow, and the better support for the deal flow coming through to investors, I think will help investors make better decisions and lower their risk going forward.
Right. So I think since I unmuted myself, I should add on one of my points. I totally agree with David. From a single family office perspective, we spend a long time to get a transaction done, which puts us at a disadvantage compared to some of the traditional and more organized managers out there. And as Hussein said, the speed to market for entrepreneurs has become very shortened because they have a lot of different investors interested in funding. The solution we have taken and seems to work well for us for now is building that knowledge base from venture partners, advisors / other people in the community, and particularly what I'm trying to refer to is university ecosystem. Since we do invest in biotech, we don't have in-house expertise per se on single molecule, multi-molecule, stem cell investments. So we rely on some of the partners that work with us. And I think for any early stage investor, since we are taking both technology and or clinical / healthcare biotech risk, having expertise is important. So we solve that by just going out there and paying for third-party diligence at times, and then building that network so that we can compete and participate in the right deals.
Yeah, so it's an interesting point you touched on. I mean, essentially, we're talking about how, to an extent, how everyone approaches the deal and how you end up still securing enough opportunities each year to deploy the funds that you want to deploy. From my personal standpoint, it seems like increasingly it comes down to either brand or speed. Either, especially at the earlier stages, when future funding rounds and future opportunities are a significant part of whether your company is going to succeed, then having a real marquee brand name investor on your cap table is hugely valuable. You know, having Sequoia on your cap table means that in future rounds that will give confidence to other investors. It will give confidence to other investors in the current round. Or you are simply the fastest. And if you turn up and you, as Hussein says, you know, if you can make an investment within a week, within 2 weeks, then that gives you the opportunity to get a seat at the table in a round. Value add has traditionally been the kind of third option. I think increasingly that is kind of diverging. You're seeing a lot of investors really nailing their value add, and they are creating in a way their own reputation for that and their own brand. But you know, most entrepreneurs surveyed asked whether their VC or their kind of VC board member added as much value as they thought they were going to. You know, it's a pretty mixed bag, because ultimately when it comes down to things, there's a point at which your interests diverge. So yeah, as Saket and David said, you know, sometimes if you are going to take that slower route, you need to just build that network. You need to make sure that people know you for the caliber of investor that you are, that either you take, you know, an exceptionally strong approach to due diligence and you have this strong network of advisors and support, or you need to be organized enough that you can process investments incredibly quickly, and that your strategy is built to a way that balances the relative risk of doing so. So yeah, it's always kind of a two-sided market in that sense, I suppose. You know, there's never just the company selling themselves. You also have to sell yourself as an investor. And whether you're a VC, whether you're an angel, your reputation and your brand and your presence and what you can bring alongside, whether you actively market it or not, is a huge part. And the slower you want to move and the more due diligence you want to do, the stronger that brand needs to be.
Thank you. I'm afraid I'm going to bring this panel to a close. It went extremely quickly, but I don't want to delay the audience anymore. I know we were unfortunately started late, and I know it's quite late for a lot of people. By all means, please, I hope I'm not misspeaking on behalf of people. Do connect with us on LinkedIn. We're happy to answer any questions. My takeaway from this is really, you know, it's still a sort of fast growing market, especially with pension funds, governments, etc. Really stimulating this market a lot. Some of the themes I've got out of this is the importance of collaboration and speaking to the right experts. There's an element of sort of winner takes it all. There was another argument around deep specialization into a particular area, difference in risk, pricing and strategies. So I suppose the advice is really just researching the investment community or type that you want to assimilate best with, and go with those rather than one single answer. Thank you so much to my wonderful panelists. Thank you to the audience, and we look forward to seeing how this changes over the next decade. Thanks, everyone.